Hey everyone, we are here with Sam Doctor. He's the CEO of BitUda, and he'll be doing a talk on how Bitcoin mining hash rate affects profitability and how miners can hedge their risk. And I'll let him take it from here.
Thanks for having me. Just to clarify though, I am the Chief Strategist and Head of Research, not the CEO. Tim Kelly is the CEO and founder of BitUda, and we are a fully regulated agency broker. We've been spending a lot of time recently focused on Bitcoin miners. A lot of them are our clients, and we work very closely with them. And the questions that we've tried to answer are really related to how much power is in use right now in Bitcoin mining, where is it located, what's the cost to mine Bitcoin, and what we think is the future outlook for hash rate. So with that, let me just move on to the first slide. So one of the things that I wanted to do was first of all address any questions that you have as well. So we do want it to be interactive, even though we'll have some time at the end for Q&A. But the first thing that I wanted to talk about was how much hash rate there is and how much power consumption the network has right now. Now, given the floods in China, as I'm sure a lot of you have seen, the amount of hash rate has fluctuated very widely in the last few days. So I think the number right now is maybe about 116 exahashes. A couple of days ago, it was 130 exahashes. And what's important to note is a fair amount of that fluctuation might be luck. And so it's impossible to know for sure exactly how much hash rate there is in operation at any point in time. The best we can do is estimate how much it fluctuates and whether it's in the margin of error. So one of the things that we looked at was starting with hash rate just prior to the halving. It reached a peak of close to 140 exahashes, and then fell quite rapidly within a week to somewhere in the neighborhood of about 80 exahashes.
Hey Sam, do you mind zooming into the slides a little bit so people can see better?
Oh, sorry. I'm not sure how best to do that because.
Oh, so you did it perfectly.
I'm on full
Maybe
screen.
just zoom in one more time.
Sorry?
Maybe just zoom in one more time. Perfect.
Okay.
Or,
all right. So.
Or actually maybe one less. Perfect.
Okay. All right. So basically what we did was we looked at the change in hash rate from just pre-halving to the immediate post-halving trough, and we made the assumption that the majority of that delta in hash rate was S9s. It's not perfect, but it is a simplifying assumption that then helped us estimate that if the remaining hash rate at the bottom of roughly about 80 petahashes, 80 exahashes, excuse me, was all S17, we could then get to an estimate of how much power consumption was taking place at the trough and at the prior peak. And since then, as hash rate has recovered, we've assumed a fair amount of that is older S9s coming back online, but also some deliveries of newer equipment. So with those assumptions, we think that there's close to about 7 gigawatts of power in use right now in the network. And that implies about 1.4 million S9 rigs in operation right now, about 1.5 million S17 rigs, and only about 200,000 or so S19 class. And when I say S17 or S19, I do mean not just Bitmain's devices, but comparable devices from some of the other manufacturers as well. We use that more as a classification mechanism rather than specifically talking about market share for any one manufacturer. That's not something we focused our research on. But with that said, we think there's currently about 7 gigawatts of power in use. What we did though was over the course of about 4 months or so, we spent a lot of time talking to different miners around the world. We captured data on about 150 mining sites in 21 countries. And of those, we found power prices on 67 specific sites. And so with that, we estimate that we know the location of roughly about 40% of operational capacity. And most of that, what we could identify at least, was in the US, about 1 gigawatt. What we identified in China was about 700 megawatts. But we think that we didn't identify all that much information about China. So, moving on to the next slide, this is our estimation of how much information we found by market, and therefore what we think the total capacity distribution is in in the mining network. So we think that China is roughly about 50% of that capacity, and that translates to almost 5 gigawatts of available capacity. We do think that some of that is off at the moment, and globally, nobody's quite at 100% of capacity at this point in time. But we think that the US is at about 14%, which I know is perhaps somewhat higher than other people might have estimated. But I think that ultimately what it comes down to is, we're all making the best efforts we can, talking to as many people as we can, and attempting to estimate what where the power is located, as well as how much it costs. So with that, let me talk a little bit about where we think the power is distributed in terms of the power cost. And one of the things we found is at the low end, at close to about a penny in a kilowatt hour, we think that there's a wide range of potential power, particularly in China during the hydro season. You can get a significant increase in capacity at this very low end of power. We think at minimum it's about 450 megawatts. That's under a penny in power cost, but it can be as much as 1.7 gigawatts. The most common power cost range, though, is the 3 to 4 cents range, and we think that that probably accounts for about 2.5 gigawatts of power. Though interestingly enough, there is a certain amount of power even higher than 7 cents, which can, I think, pose a challenge for miners. Because when we think about what it costs to mine one Bitcoin, what we feel is that the lower the power cost, clearly, the cost to mine one Bitcoin is lower, although the mix at the low end might also skew towards less efficient equipment. But despite that, we think that there's a small amount of mining capacity that is currently mining Bitcoin at even uneconomical prices. We think that there's a small amount that's mining at close to $12,000 in cash cost, not accounting for any depreciation or or certainly no profits, but just on a pure cash cost basis. We think the median is roughly about $5,000, and it could be as high as $13,000 or $14,000 for a very small percentage of the mining market. That's, I think, a really interesting thing to think about as well, because one wonders, why is it that there might be miners in operation at that price? With the recent run we've had in Bitcoin, certainly it's not as many miners mining unprofitably as it was a few weeks ago, but still it's a question that's worth answering and thinking about. We think that some of it might be because you've got existing power purchase agreements. You're basically, as a miner, you've guaranteed the utility that you're going to take a certain amount of power. So you have to take it even if it's not economical to mine. But the other aspects to that might also be non-economical, particularly in certain markets where you don't mind paying the premium to mine Bitcoin, because that's one way of essentially getting a fungible currency that you can move around globally. So then the question is, what happens with hash rate going forward, and how far can it go? And certainly from what we saw was the peak in May, we think that power capacity is continuing to grow at perhaps 10% or so a year. Part of that is because of large projects that continue to come online, and at the same time, we think that some of the some of the mining projects that are at extremely high power costs might be either shutting down or relocating to lower power price markets as well. So with that, and assuming that a lot of the bounce back that we see in hash rate from here, if a lot of that is S19 class devices, the Wattsminer M30s and so on, we think that the hash rate can get to about 260 exahashes in about a year or so from now. Now, the trajectory over the last month or so has been fairly muted, and looking out over the next few months, it's unclear how much hash rate will grow for a couple of reasons. I think there certainly has been some disruptions related to the floods in China, but that is likely to be a passing phase. The other disruption we've seen in the supply chain is that there have been delays of mining equipment shipments from Bitmain. There's been a number of articles in the public domain that talk about some acrimony between the founders of Bitmain. We don't have any insight into that. All we know is that as we speak with miners, they are seeing disruptions and delays in shipments. And so that, I think, might delay the pace at which hash rate grows over the next few months. But ultimately, the chips are being manufactured. Many of the chips that will be shipped and delivered in the next 6 or 7 months have already been paid for. And so it's a bottleneck at the assembly stage. It's a bottleneck at the distribution delivery stage, but it's not a fundamental bottleneck in production, which means we think that when things clear up, you could actually see a significant pickup in hash rate as deliveries really start accelerating. So with that, I think one of the things that we really need to consider is, as hash rate increases, what does that do to profitability for miners? And I think the first thing we look at is how much BTC are earned per day, per petahash, as hash rate increases. That's the upper chart over here. Let me zoom in a little bit more as well. And so, as you can see, post-halving, there was a decline in the BTC earned per day. As hash rate increases, you would continue to see a decline in Bitcoin earned per day per petahash. Now, what that translates to is, at the moment, roughly about 0.0085 Bitcoin per petahash per day, which at about 11,600 is roughly about $97 of revenue per day. So to put that in context, if your cost of power, right, actually, let me take that to the next slide, and that might help translate this. So what we're showing here is the income in Bitcoin per megawatt hour, depending on what equipment you're using. So with higher efficiency equipment like an S19 Pro class of devices, you could end up earning close to 0.01 Bitcoin. You get 0.097 Bitcoin per megawatt hour. And that compares with 0.0027 if you are mining with S9 devices. The difference is that with S19, then, at today's prices, you receive $112 per megawatt hour in revenue. With an S9, you only receive $31 in revenue per megawatt hour, which means if your power cost is 3 cents a kilowatt hour, that's $30 per megawatt hour, you're essentially paying for power, but not really for labor, and certainly no profit and no recovery of your cost of the mining equipment. So for S9s to continue operating at this point in time, which is where we are with our target hash rate of 121 exahashes, at that level, you need to be at probably 2 cents or under to be able to make a cash profit mining with S9 devices at the current price of Bitcoin. Now, if the price of Bitcoin increased, you would see the value of this the Bitcoin that you're mining going up. Correspondingly, if hash rate increases, you actually see a decline in BTC earned per megawatt hour. And as you can see, the curve is steeper on an S19 than it is on an S9, just because on an S9 you're already at the point where at really diminishing returns. What that also means that what we found is that it takes $1,000 increase in the price of Bitcoin to offset a 10 exahash increase in network hash rate, and essentially to maintain profitability. And so that's really critical when we think about what does it take for hash rate to get to 260 exahashes. For that to happen, it requires a tremendous amount of investment. And unless Bitcoin prices were to increase at, to simplify, at $1,000 per 10 exahashes. So if you're looking at it doubling from here, unless the price of Bitcoin got to $25,000 or above, you would see a decline in profitability for miners. I think that's something that's really important to think about, and that's something that we pay a lot of attention to. So there's a couple of questions that I see in the chat, and I'd maybe start with that and open it up to questions as well, because this actually brings me to the end of the presentation. So what I have over here is basically maybe open it up to Q&A. I see a question about proof of work protocol. I think it's a great question whether we can think about extending what the work that we have done with mining capacity into streaming services. I think that it's very difficult to compare the two, because what we talk about as the cost of operating the Bitcoin network is essentially a power cost to run computing equipment. What it would be in the case of, say, somebody like Netflix or a streaming service is really a lot more related to the input-output or transport of the data. The data certainly needs to be hosted on on the servers, but it really comes down to the cost of transportation and streaming, which is really not the case in Bitcoin. Bitcoin is not a bandwidth-intensive mining network. Thanks, Ethan, for that question. I think that's a great question. What percentage of mining is self-mined versus hosted, and what percentage are mining for reasons other than mining profitability? I think that those are both great questions. As far as the second one is concerned, I think it's impossible to tell, but I would guess that it's probably in the neighborhood of maybe at minimum, I would say it's probably about 5 to 10% are mining for reasons of capital controls. Whether that might be in Iran or Venezuela or or a variety of other such markets, North Korea perhaps. It could be certainly more when you think about China and whether that is economic versus capital controls. I think that Chinese mining is profitable for the most part. And so whether there might be a secondary benefit of managing capital controls or working around capital controls, the primary reason for mining in China is not capital controls. So I think that where it is the primary reason, it's probably only about 5 to 10%, but it's hard to tell. As far as what percentage is self-mined versus hosted, that's a difficult question to answer. When we spoke with our miner clients and various players in the space, the price of power that we've identified and that I shared on these, in the presentation, is the cost of power that the facility faces. So it's not the hosted cost. When the miner offers hosting the services to their clients, they're paying, let's say, 3 cents per kilowatt hour. But on top of that, they're also incurring their own costs and a margin before they set up a price of, let's say, 5 cents or 5.5 cents that the hosting client pays to the host. It seems to us that the share of hosted has continued to grow. And at this point, most of the large players in mining have at least some part of their capacity that's hosted. So I think there's I would probably say that at least 75 or 80% of the miners we've spoken with have some portion of their business hosted. It's not always the same. Some clients, focus primarily on hosting, and some, use hosting as a mechanism to make up for potential shortfalls in their access to capital because they have more power capacity than they have the capital to fully equip themselves. So I think I would say it's a mix of that. Um, so the next question that we have is looking at the profitability based on both power prices and capex. Um, I mean, ultimately, that's exactly right. I mean, what we are looking for when we talk about the price to difficulty, the way we look at this is either the revenue per um, per megawatt hour or the revenue per petahash. I think the revenue per petahash is a much cleaner way to express this based on the target hash rate for each difficulty epoch. And the reason for that is that then becomes device independent. Whatever mix of equipment you might be running, if you have a petahash of capacity, you're going to get, about $97 per day in revenue at current Bitcoin price. And I think that's important to remember. So, whether we look at it as price per difficulty, which I think is a more abstract number, my preference is to look at it as the revenue per uh, per petahash, and then depending on the individual miner who's looking at their own project and looking at their mix of equipment, you can look at it per megawatt hour for an S9 class of equipment or an S19 class of equipment and so on. So are there any further questions or follow-ups? I think this is a great question. Do Bitcoin miners want a way to hedge against an increase in hash rate? I think absolutely there is a clear need to hedge against difficulty because, as a miner, you know exactly what your cost is going to be to run your business a week from today or a month from today and possibly a year from today. What you don't know is how much Bitcoin you're going to get, when you incur those operating costs. That's dependent on difficulty. And what you also don't know is how much the Bitcoin is going to be worth. Now, you can certainly look at selling your production forward, and there's a futures market that's becoming increasingly liquid. So certainly there are ways that you can look at hedging against price. Hedging against difficulty is a different question, and I think that there are products. Bituta certainly has worked on a number of products that can help clients in that area. But what might be most interesting, I think, in terms of hash rate contracts and products such as that, are for miners whose power costs are more or less near the median. Because if you're a miner who's operating at, let's say, 1.5 cents a kilowatt hour, you are naturally hedged over the medium to long term, in the sense that if difficulty increases and profitability falls across the board, you're going to find higher cost miners potentially shutting down their business, or certainly shutting down part of their capacity because it's no longer profitable for them to mine. And that protects the low cost miners and essentially acts as a sort of upper limit on hash rate. If you're more towards the middle of the pack, I think that's where products like Bituta hash rate contract can really help hedge you against that difficulty. I think that you certainly can look at this approach for other proof of work coins as well. Certainly Ethereum is something that we've been looking at, and you can certainly model out what is the revenue to a miner, per terahash or per gigahash of Ethereum GPU mining capacity. And certainly that can be in aggregate, when you think about the network rewards that are earned by all the miners, it is a combination of transaction fees of block rewards as well as the rewards for uncle blocks as well. I think that one interesting thing to think about as a GPU miner, and I think that's an area that I don't have as much experience in as I do in ASIC mining and Bitcoin. But the one thing I would consider is that if you look out into the medium term future, past a successful launch of Ethereum 2.0 and a move to proof of stake, that essentially frees up 220 terahashes of GPU mining capacity that then needs to either move entirely out of cryptocurrency mining into maybe some other applications, or what might end up being more likely, moves into mining other GPU mineable tokens, which I think certainly raises a lot of a lot of questions in my mind about what that can imply for for the state of the profitability of mining other tokens that are GPU mineable. Ethan, I certainly looked at the FTX difficulty products. I have, to be honest, I don't really have a great handle on them, and so I would refrain from commenting on something that I feel I don't really have a good handle on, to be honest. So perhaps I should take a pass on that question. Would there be something else that any other questions that we could follow up on? I guess if there aren't any further questions, maybe I should just hand it back over to Sindhu.
Yes, that'd be great. So we're ready to transition to our next session now. Thanks so much for the really great talk. A lot of good questions too.
Yeah, thanks for all the questions. I really appreciate it.
Yep. All right, we're transitioning over now.